Two men, both 60, both sitting on $2 million in their 401k, and both of them did the exact same thing after watching financial videos online. They decided to convert $50,000 per year into a Roth IRA. Smart move. Get ahead of the 2026 tax hike before it hits. 15 years later, one of them has hundreds of thousands of dollars more in tax-free growth, completely untouched by the IRS. The other one did the math and went quiet. He realized his account had been quietly bleeding out for over a decade, and the worst part? He did it to himself. One small decision, one detail he never thought twice about. They converted the same amount. They paid the same tax rate, same brokerage, same strategy, same year. The only difference was where they pulled the money to pay the IRS. That's it. Not how much they converted. Not when they started. Not which funds they picked. Just the source of the tax payment. That one variable separated a retirement that worked from one that quietly unraveled. 90% of the financial content out there will tell you to do a Roth conversion. Some of it will even tell you how much to convert, and when to convert, and which accounts to prioritize. Almost none of it will tell you this part. If you're around 60 and most of your money is sitting in a 401k or a traditional IRA, this video is going to walk through the liquidity math behind Roth conversion that most advisors won't say out loud, not because it's complicated, because it's uncomfortable. And once you see it, you won't be able to unsee it. Not your fault you put everything into a 401k. For 30 years, every advisor, every HR packet, every financial article told you the same thing. Contribute pre-tax. Lower your taxable income now. Let it grow. Pay the taxes later when you're in a lower bracket. You did exactly what you were taught. You did it well. The problem is later is now. And the bracket you were promised didn't survive contact with 2026. Here's the window most people don't realize they're standing in. The years between when you retire and when RMDs kick in, that stretch of time is genuinely one of the most valuable tax planning opportunities you will ever have. Your W-2 income is gone. Social Security might not have started yet. Your taxable income is, for a brief moment, unusually low. That's the tax honeymoon, and it doesn't last long. Because at age 73, if you were born between 1951 and 1959, the IRS stops asking and starts telling. Under SE Cure Act 2.0, required minimum distributions begin. If you were born in 1960 or later, that clock starts at 75. Either way, it starts. At 73, the required withdrawal rate on your account is 3.77%. At 75, it climbs to 4.7%. If you have $2 million sitting in a 401k, that means the IRS will force you to pull out somewhere between $75,000 and over $80,000 in the very first year, whether you need the money or not. Whether the market is up or down, the distribution is mandatory and it is fully taxable as ordinary income. That alone could push you into a bracket you spent decades trying to avoid. And starting in 2026, those brackets got steeper. The Tax Cuts and Jobs Act has officially expired. The 12% bracket reverts to 15%. The 22% bracket goes back to 25%. The 24% bracket climbs back to 28%. For a married couple with $200,000 in taxable income, that's roughly $4,800 more in federal taxes every single year, just from the expiration alone. You didn't change anything. The law changed around you. Then there's IRMAA. A lot of people hear about this one too late. In 2026, if your modified adjusted gross income exceeds $103,000 as a single filer or $206,000 as a married couple, Medicare starts charging you a surcharge on top of your standard premiums. We're talking an additional $900 to $5,700 per person per year, depending on how far over the threshold you land. And RMDs count toward that income calculation. So a large 401k doesn't just create a tax problem. It can simultaneously trigger a healthcare cost problem. I don't have a crystal ball. I can't tell you whether the S&P 500 goes up or down next year. But I can tell you with complete confidence that the IRS will not forget to send you a bill the year you turn 73. That part is not optional. So when you put all of this together, the expiring tax cuts, the forced distributions, the IRMAA cliff, it starts to make sense why so many financial voices are telling you to act now. Convert to Roth before 2026. Lock in the lower rates. Get ahead of the RMDs. That advice is not wrong, but it is incomplete. Because none of those voices are asking the question that actually determines whether the math works in your favor or against you. They're focused on how much to convert and when to convert. They're skipping over where the money to pay the taxes is going to come from. That is the variable that changes everything. Remember the two men from the beginning. Same age, same account size, same conversion amount. Both moved $50,000 from their 401k into a Roth IRA. Both paid 25% in taxes on that conversion. Both wrote a check to the IRS for $12,500. The only question is, which account did that check come from? Person A went into his savings account, pulled out $12,500 in cash he had been sitting on outside his retirement accounts, sent it to the IRS. The full $50,000 landed in his Roth IRA and started compounding immediately, completely untouched. Person B looked at his bank balance, felt the discomfort of watching that much cash leave his account, and told his broker to just withhold the $12,500 directly from the 401k distribution. Easier, cleaner, one less wire transfer to think about. What he didn't realize is that he had just made the most expensive convenience decision of his retirement. When person B withheld from his 401k, only $37,500 actually made it into the Roth IRA. The other $12,500 went straight to the government and never compounded again. At 7% annual growth over 15 years, that $37,500 grows to roughly $103,000. Person A's $50,000, fully intact inside the Roth, grows to approximately $138,000 over the same period. Same tax bill, same strategy, same time horizon. Person B permanently gave up around $35,000 in tax-free growth. Not because he made a bad investment, not because the market turned on him, because of one checkbox on a form he filled out in about 30 seconds. That is the hidden math. And it does not show up in any of the Roth conversion calculators you'll find online, because those tools assume you're paying the tax from outside. They don't model the scenario where you're cannibalizing the very engine you're trying to protect. When you withhold taxes from your 401k to fund a conversion, you're not just paying the IRS. You're pulling capital out of a compounding machine at the exact moment you're trying to supercharge it. You are shrinking the base that the next 15 years of growth will build on. Every dollar that goes to taxes from inside the account is a dollar that will never again generate tax-free returns. That is the trade-off nobody puts in the headline. I used to believe Roth conversion was a universal solution. I recommended it to clients as a near automatic move. Get in early, convert aggressively, let the tax-free growth do the work. Then I ran the actual cash flow models, long-term, scenario by scenario. And I found myself staring at a spreadsheet that showed clients I had worked with could have quietly lost tens of thousands of dollars in future compounding, not from bad investments, but simply because they didn't have enough liquid cash outside their accounts to cover the tax bill cleanly. That was a cold moment. The mechanism is straightforward once you see it. A Roth conversion only delivers its full mathematical promise when 100% of the converted amount enters the Roth account. The moment you divert any portion to cover taxes, you've permanently reduced the principal that compounds tax-free. And because we're talking about retirement timelines, 10 to 20 years of compounding, the cost of that reduction doesn't stay flat. It multiplies. If you enjoy seeing the actual math behind financial strategies instead of just the talking points, take a second and hit subscribe on the Wes Investor channel. This is exactly the kind of analysis we do here every week. So the question is not whether to do a Roth conversion. For most people in their early 60s, with large pre-tax accounts, some level of conversion before RMDs kick in is a sound strategy. The real question is whether you have the liquidity to do it correctly. And this is where I see a pattern that almost nobody talks about publicly. There are people with $2 million in retirement assets who genuinely do not have enough free cash sitting outside those accounts to fund a meaningful conversion without touching the 401k itself. They are not broke, not even close. But they are what I call cash-poor millionaires, and that label makes some people defensive when they first hear it, which is exactly why it deserves its own conversation. Last month, I sat with a client, solid guy, retired engineer, very deliberate about money his whole career. We had already walked through the math together. He understood the mechanism. He knew that paying the conversion tax from outside his 401k was the correct move. He agreed with every number on the page. Then I asked him to write a personal check for $12,000 to the IRS. His hand stopped. He sat there for a moment, pen hovering. Not because he didn't have the money. He had it. But something in his body resisted the act of watching that amount leave his bank account in one movement. I understood it completely. Watching cash physically disappear from your checking account registers differently in your brain than watching a number shift inside a retirement portal. One feels real. The other feels like accounting. The pain is not proportional to the actual financial impact, but it is very real. That reaction has a name. Behavioral economists call it loss aversion, and it hits harder when the loss is visible and immediate. The $12,000 leaving your bank account today feels like a wound. The $35,000 in future tax-free compounding you silently give up by withholding from your 401k instead, that loss is invisible. It happens slowly, over 15 years, on a spreadsheet you'll never see. We are wired to avoid the pain we can see, even when it costs us far more to avoid it. And this is not a personal failure. It is the predictable outcome of a financial life built almost entirely inside tax-deferred accounts. Most Americans between 55 and 65 have the majority of their wealth in two places: home equity and retirement accounts. Their checking account might hold $30,000 to $50,000 on a good month, sometimes less. The money is real, the net worth is real, but the liquid cash available to deploy outside those walls is surprisingly thin. That structure made complete sense during the accumulation years. Put the maximum into the 401k, build equity in the house, keep spending lean. It was the right playbook for decades. But now the game has changed, and the playbook hasn't updated. When the only cash available to cover a conversion tax bill is sitting inside the same 401k you're trying to convert, the tool starts working against itself. You are using the asset to pay the cost of repositioning the asset. The math collapses. Reframe this for a moment. Writing that check from your bank account is not losing money. It is buying back the right to compound tax-free for the next 20 years from a government that would otherwise tax every dollar of growth in that account. You are purchasing future freedom with present cash. That is an investment with a very clear return, not an expense. The discomfort is real. The reframe is also real. And once you start thinking about it that way, the question shifts. It's no longer, can I afford to pay this tax bill from outside? It becomes, how do I build enough of a cash buffer outside my retirement accounts to make this strategy actually work? That question, building the right cash position before you convert, is something most people haven't planned for, because nobody told them it was part of the equation. But there's one more layer here that can make even a well-funded conversion go sideways, and it has nothing to do with your tax bracket or your cash reserves. It has to do with when you convert and what the market does right after. Let's say you've done everything right so far. You have the cash buffer sitting outside your retirement accounts. You understand the funding math. You're ready to convert $50,000 before the 2026 tax hike locks in. So you move in January. S&P 500 is near an all-time high. You convert at peak valuation, pay the tax bill from your savings account, and feel good about the decision. Then 2027 arrives. The market drops 20%. Your Roth account, which held $50,000 at conversion, is now worth $40,000. But here's what doesn't change: the tax bill you already paid. You wrote that check based on a $50,000 valuation. You paid for $50,000 worth of assets. You now own $40,000 worth of assets. You paid full price for something that went on sale the following year. That $10,000 gap is not a paper loss you can wait out. It is a permanent overpayment on a transaction that already closed. The conversion is done. The tax is gone. And the assets that were supposed to compound tax-free for the next 15 years are starting that journey 20% below where you bought in. This is sequence of returns risk applied to conversions, and almost no one talks about it in this context. The FOMO around 2026 is real. The tax rates are going up. The window feels like it's closing, and the financial content ecosystem is pushing urgency hard. Convert now, convert fast, get ahead of it. But urgency and market timing are a dangerous combination. Converting a large amount in a single move at peak valuation is not a tax strategy. It is a bet. You are locking in a tax cost based on today's asset prices, with no guarantee those prices hold through next year or the year after. The people who navigate this well are not the ones who moved fastest. They are the ones who spread the conversions out. Monthly conversions, sometimes called DCA conversions, smooth the valuation risk over time. Some months you convert at a higher price. Some months you convert lower. But you are never fully exposed to a single market moment. And when the market does pull back, a downturn is not a threat to your strategy. It becomes a discount window. You are converting the same dollar amount of income, but buying more Roth shares at reduced prices, which means more assets compounding tax-free on the other side. A 15% or 20% market correction for someone doing systematic Roth conversions with outside cash is not a crisis. It is a flash sale. That reframe only works if you are not rushed, not over-concentrated in a single conversion, and not using retirement funds to pay the tax bill. Tax planning is never a straight line. It does not respond well to urgency, and it does not reward the people who move the hardest. It rewards the people who build the right structure first, then execute with patience. The market will give you entry points. You do not have to manufacture them by converting everything at once in a single calendar year. So let's bring it back to the two men at the beginning. Same age, same account, same strategy. One of them ends up with $35,000 more in tax-free growth, not because he was smarter, not because he had a better advisor, but because he understood one thing the other missed. The funding source is not a footnote. It is the entire equation. Roth conversion is a genuinely powerful tool. For someone in their early 60s with a large pre-tax account and a real window before RMDs begin, a well-executed conversion strategy can reshape the tax burden of the next 20 years in a meaningful way. But powerful tools have edges, and this one has 3 rules that determine whether it works for you or against you. Rule 1. Never use money from inside your 401k to pay the tax on the conversion. Not for convenience, not because it feels simpler, not because you want to avoid moving money between accounts. The moment you withhold from the distribution, you are shrinking the principal that compounds tax-free. That cost does not stay fixed. It multiplies over time. Rule 2. Build your cash buffer before you convert, not while you're converting. This means sitting down now and calculating what a meaningful conversion will actually cost in tax dollars, then making sure that amount is available in liquid cash outside your retirement accounts before you initiate a single transaction. If the cash is not there yet, the answer is not to withhold from the 401k. The answer is to wait, accumulate, and convert when the structure is right. Rule 3. Do not let the 2026 deadline drive you into a single large conversion at peak market valuation. The tax hike is real. The urgency is understandable. But converting everything at once in a hot market is a timing bet disguised as a tax strategy. Spread it out. Let market pullbacks work in your favor. Treat this as a multi-year plan, not a single event. 3 rules. None of them complicated. All of them easy to skip when the noise gets loud. Roth conversion is one of the sharpest instruments in retirement tax planning. But like any sharp instrument, what matters is not just that you use it, it is how you hold it. If you found this useful, subscribe to the Wes Investor channel. This is the kind of analysis we work through here consistently. The actual mechanics behind the advice, not just the advice itself. Because knowing what to do and understanding why the math works are 2 very different things. And the difference between them is usually measured in dollars.